Good morning and welcome to today's webcast, How Tax Reform Affects Food, Beverage, and Agribusiness. Before we begin, I will play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And Ryan, I'll turn it over to you to get us started.
All right. Thank you, Emily. Well, good morning, everyone. This is Ryan Kuenzi, a tax partner here in our Portland, Oregon office, and I'm joined with Nick Frank, a tax partner out of our Tacoma office. And as the title indicated, we're going to talk about tax reform today. And certainly there's been a lot of news, out in the public domain, if you will, regarding tax reform. But today we're going to focus more specifically as to those that would be operating in the food, beverage, and agribusiness space. And some of the provisions that would be unique to the industry that we work in. Nick and I have the pleasure of working almost exclusively in this space, and so there's certainly aspects of the tax reform that will be very applicable and others that may not be as applicable. In front of us, we have an agenda for the day. It's probably a little bit aggressive on our part to think that we'll be able to cover all of this in the hour, but our goal is to be that we'll hit the significant points of these various provisions across both individuals, businesses, choice of entity, cooperatives, ICDIS, et cetera, and how they apply in the food and beverage space. To begin, though, Emily, we're going to move to the first polling question.
All right, thank you. Our first question of the day is, how much do you know about the Tax Cuts and Jobs Act of 2017? A lot, I'm an expert. A little, I've read something somewhere. Or nothing, Tax Cuts and Jobs Act? And I'll give everyone a few moments to respond. To participate, please click the button next to the answer you choose and hit Submit. All right, and let's go ahead and take a look at the results. Ryan, back to you.
Sure. All right. Thank you, Emily. So it looks like a lot of us have some amount of exposure to the Act, and certainly, something to comment on now is the fact that all of us are still in a learning mode to a degree. As some or all of you may be aware, what we have at this date is the actual statute of the bill that was passed in Congress and signed by the President. But one thing that we're all awaiting upon for further direction and guidance will be the actual regulations and guidance from the IRS as to how we'll take the new law and apply it in certain circumstances. So this webcast will be talking about the statute and how we anticipate that the law will be applied, but we'll all be learning more as the year progresses. Just a little bit of background as we watched the legislative process unfold. As we all experienced, it came together fairly quickly in the month of December between the House and the Senate passing their various versions of the bill, and then the separate bills then going to conference, agreeing on a conference draft of the law, and then going to the President for signature on the 22nd. One thing to keep in mind, though, is even though it had the appearance of being fairly quick, and certainly there's aspects, and we'll touch on that today, that are evidence of the writing process going quickly. A lot of the core provisions of the statute were really provisions that had been worked on over the past number of years, and so Congress was leveraging that work fairly extensively, and then putting on the expectations, if you will, of the administration and baking those into the language writing. First, we thought it'd be good to run through some of the individual provisions, and really from a highlight, and I'm going to run through these slides fairly quickly. A lot of us are probably more in touch with the individual provisions than we are with the business provisions, but the goal overall of the bill was for simplifications. And so that simplification, in part, came from a reduction of the overall rates on the graduated rate scale, a limitation on the type and amount of deductions that you could take individually, whether that was the miscellaneous itemized deduction. We'll talk about the state and local tax deduction here in a moment, and really to eliminate the exemption for dependents, and in exchange for that, removal of the exemption to provide for both the child tax credit as well as expanded standard deduction amounts. Also, too, as we watched the last year unfold legislatively, it was on the Republicans' agenda to have some form of repeal of the Affordable Care Act. As we watched it occur, they didn't get that across the finish line, but included in the bill here was a repeal of the mandate regarding the use of the Affordable Care Act and signing up for insurance. And with that, if you recall, the Affordable Care Act imposed a tax penalty, so to speak, on your individual return if you didn't have full coverage. That penalty has now been waived, or that responsibility payment, as it's called, has been waived, and so it's no longer required. And so the Republicans achieved their goal on that front as well. Just a little bit on rates. Broadly speaking, top rates came down. The old top rate of 39.6% got replaced with the 37%. We're still left with a 7-bracket system at the various income points, and you can see where, in a few instances, namely like at the 35% bracket, it kicks in, for a much smaller scale, or a much larger, rather, scale of the income, and it kicks in a little bit earlier than what it did under the old law. So there is, in a few instances, a few spots where rates did move, and you might find a few people that are impacted by that slight and subtle difference. Here, too, the brackets for individuals, if you're filing on a single basis. We talked about the deductions, personal exemptions being suspended, the standard deduction being increased, which for a lot of people, that's going to be a win, net for them in terms of their tax cost. A big one to talk on, this impacts both business owners and non-business owners alike, is the fact that the AMT, even though it wasn't repealed at the individual level, the AMT exemption amount was raised significantly, You see there for married filing joint of going from $109,000 and change up to the $1 million for married filing joint and $500,000 for all others. In some of our initial modeling, we're finding that this change alone is probably one of the significant drivers for a lot of taxpayers in reducing their tax obligation when you compare 17 to 18. We talked about itemized deductions a little bit already. The one that's gotten the most news has been around the limitation of deductions for state and local income taxes, including property taxes. Here they've limited it to $10,000 a year, whereas the old law allowed for deduction of the full amount of what was paid in the calendar year. However, one thing to keep in mind is for those that were in the AMT tax system, you likely weren't getting much, if any, of a benefit from your state tax payments, as it were. And so in some instances, being able to deduct $10,000 worth is now better than the old system of not getting a deduction at all because of AMT provisions. Further changes to itemized deductions, they increased the AGI limit on cash contributions to the 60%. They repealed some of the benefits around university athletic seating rights. And then also, too, the PEAS limitation was repealed through 2025. The PEAS limitation, just for a reminder, is the limitation whereas married filing joint, it was at about $300,000 of AGI. Your itemized deductions would start getting limited for every dollar above that. So that limitation is gone. Another one, too, that got a fair amount of news but didn't change a whole lot was the itemized deduction for home mortgage interest. That's been limited now to $750,000 of qualifying debt. And also, too, for those that would have loans that were between the $750,000 and the old $1 million mark, those loans have been grandfathered in. You can see as well they made some changes to the medical expense deduction, and miscellaneous itemized deductions were suspended altogether. Give you a quick example here. You can see that even though in the new law you may not get the full benefit of your state tax deduction, you might still be better off because of the removal of the PEAS deduction, or the PEAS limitation, rather. So it really is a facts and circumstances measurement, and we would encourage all of you to sit down with your tax advisor as you understand the new law, because this will certainly have an impact on what you would pay from a quarterly and annual basis. Also, too, another planning point real quick is the whole idea of bunching itemized deductions to the extent that you can control them. One that you can certainly control would be charitable contributions. For some taxpayers, as you can see here in this example, it might be more beneficial to take your charitable contributions and bunch 2 years into 1 year to be able to take all those deductions in the same year and then utilize the standard deduction in the following year to maximize your deductions. Another thing to talk about with your tax advisor. We talked about the Affordable Care Act and the responsibility payment going to zero, more or less gutting the provision there and the requirement of people to sign up for insurance. Another big one is the estate tax and GST and gift tax exemption amounts being raised considerably. Here in a pictorial format, you see the old law at the left-hand side of the chart. Now with the new law, they approximately doubled the exemption amount, where it's now in the current year approximately $11 million per individual, and that's indexed to inflation. The thing to keep in mind with many of the provisions in this act is that they're sunsetting, and so they're not locked and set in concrete, so to speak. So you can see here with the chart that if you're planning on doing some transition work around your family business, or you're planning other estate planning, you might have a window of opportunity here to get in and do some of your planning with, because we don't know what the future would hold. It's safe to say nothing is permanent in the sense of tax law, and so with that, I think while we have the opportunity, it's something worth considering. Carried interest for some of your organizations where you've provided a profits interest to key management members. In order to get capital gains treatment on that profits interest, if you were to sell the entity, the holding period is now 3 years on that, so that's an extension of the holding period. That being said, there was conversation about scrapping carried interest altogether in the favorable capital gains treatment, but Congress did not get that far in their writing. Another thing to think about is really AMT timing of when you might exercise incentive stock options and other AMT preference items. But like we talked earlier before, for AMT in particular, because of the increased exemption amount in the phase-out, really it's grabbing fewer taxpayers into the alternative minimum tax structure. So thankfully, some relief there. Me personally, I wish they would have gotten rid of AMT altogether, but unfortunately I don't sit in Congress, and so we still have the AMT provisions to deal with. Moving on now to more of the business provisions, we thought it would be helpful to talk about new tax accounting methods that were adopted as part of the Act. One of those, couple of those critical methods that are now available all revolve around a new gross receipts cutoff of $25 million. And that's a $25 million over the past 3 years, an average of the prior 3 years. And for a taxpayer that's under that threshold, one, you can now use cash basis of accounting, so cash method, and you can make a method change to adopt that, which certainly there would be a benefit for a lot of our clients and companies to do that. Two, really in an attempt to provide some simplification, Congress allowed and provided an exemption from maintaining inventories under Section 471. So if you're under the $25 million cap, you wouldn't have to maintain your tax inventories. So you could either treat them as non-incidental materials and supplies, or you could follow whatever you do for financial statement purposes. A third method that they made available was in regard to an exemption from the Uniform Capitalization Rules of 263A. I'm certain many of you have had those conversations previously with your tax advisor. And the benefit here is for those in particular in the ag space, if you're under the 25 million mark, frequently you had to wrestle with 263A if you were in the permanent crop space. So if you're installing permanent crops such as whether it was wine grapes, a tree fruit, hazelnuts, citrus grove, etc., you would run into these 263A rules, and in order to get out of 263A, which you could get out of it, you could make the election to not follow 263A, you would have to follow longer-lived asset depreciation methods under the ADS system. So this allows, in ag in particular, a spot where you can not only sidestep 263A by virtue of where you're at gross receipts-wise, you could then utilize accelerated depreciation methods along with other taxpayers. Another one, method change, which I would anticipate would have a little bit less application in this space, but occasionally you might run into it, would be taxpayers under the 25 million mark are exempt from the percentage of completion method for long-term contracts. And so another favorable change, and where genuinely there could be some simplification obtained. Another thing to keep in mind is if you are an accrual method taxpayer who has an applicable financial statement, you do need to follow, and report income no later than what you had reported in your financial statement. And for the background on applicable financial statements, one, if you have an SEC filing of a Form 10-K or an audited financial statement, you have an applicable financial statement. This does not apply to companies that have either a compilation or a reviewed financial statement prepared. From time to time, taxpayers receive advance payments. An example to think about here is if you're to provide a gift card or something like that, where a consumer of yours pays in advance. Under the past, there was a revenue procedure where you could defer that. Now, the new Tax Act codifies that language, and you can defer inclusion into income up to 1 year or up to the point at which it's deferred in your applicable financial statement. With that, changing gears, we're going to talk a little bit about the interest expense limitation. One change here is that Congress put in a limitation around the deduction of interest expense. And that limitation, when you read through the details of it, is more or less you take your taxable income and you calculate an EBITDA based on your taxable income where you add back interest, depreciation, amortization, and taxes. You take that amount and you multiply it by 30%, and that amount generated is your limit that you can deduct. Now, a couple things to keep in mind with that limit, and we'll have an example here in the next slide, is for farming and real property trader businesses, if you find yourself in a spot where you are being limited, one option you have at your disposal is you can elect out of this limitation. However, you need to follow ADS lives and methods for certain real property. The other thing, too, is this change in the law does not apply to taxpayers who have less than $25 million of gross receipts. And so in instances where you may not have a lot of taxable income, you think of a real estate holding company. That being said, frequently you probably don't have over the $25 million of gross receipts in that entity. So you'll likely be able to sidestep it here. Really the thought process and the intent behind this was that Congress, with allowing for 100% bonus depreciation, which we'll cover in a minute, they didn't want companies to go out and leverage themselves up to the hilt just to take advantage of the deduction. And so this is kind of a constraint that they put into the law to keep companies appropriately capitalized as they move forward. Just a quick example, and I'll let you read this on your own time just so we can keep moving through the slides. But you can see where that EBITDA calculation, the tax EBITDA of the $1,000 on here, limited to the $300, and then you compare the $300 to your actual interest expense. Moving into fixed assets, a big change in the law here was around bonus depreciation. Old depreciation rules were 50% bonus, and now it's expanded to 100% bonus depreciation for qualified property acquired and placed in service after September 27th of 2017. And then you see in the phase-outs that will then stair-step down from 100% to 80% and down. A critical thing when you're looking at your 17 tax filings and you're looking at assets placed in service inside of that window from September 27th through the end of the year, keep in mind that you need to evaluate whether you had a binding contract in place for the purchase of that equipment in advance of the 27th of September. If you had a binding contract, review that with your tax advisor because there's a chance that you may not be able to qualify for the 100% bonus if you placed that asset into service after the 27th of September. Another thing, too, arm's length related party transactions need to evaluate that they are truly at arm's length for purchase and sale considerations. Congress also created a new designation around property, as they've been prone to do in the last number of years. They created the new qualified improvement property, which replaces the old qualified leasehold improvement, qualified restaurant, and qualified retail improvement property. With this, there was some confusion because the old qualified improvement categories of the qualified property categories had a 15-year recovery period and were eligible for bonus. And those definitions extended through December 31st of 17. And then the new definition started 1/1 of 18 and forward. So for taxpayers that are putting qualified improvement property into place in the period of time from September 27th through the end of the calendar year 2017, you might have an opportunity to take 100% bonus on those assets. And the IRS came out and published some guidance to that effect as well, but we would advise you to consult with your tax advisor on that point to see if you have an opportunity there. 179 was expanded from the old $510,000 to $1 million, and the phase-out is now $2.5 million versus the old phase-out of $2 million. They expanded it to include qualified improvement property and other non-residential real property improvements, and so certainly an area where you can take more advantage of the new law with asset acquisitions and whatnot. The thing that we would just caution briefly here is with the expanded depreciation rules and the reduction of tax rates overall, you might not want to accelerate all of your deductions into the current period, just on the whole thought and premise that tax rates in the future might go up. And so think about how you would balance your deductions both today and into the future so that you don't find yourself in a spot where you're deducting all of your depreciation at the low rates today, and then you have that timing difference reversing on you in some future period where you'd be paying tax at a higher rate on your income. Here on like-kind exchanges were limited to real property. I know many in the food processing, ag space in particular, would occasionally do like-kind exchanges on equipment. That no longer qualifies. At this point, I'm going to turn the presentation over to Nick.
All right, thank you, Ryan. So we're going to spend the next 20 minutes or so talking about some of the other business provision changes, and then I'll kick it back to Ryan to talk about some stuff in the cooperative space. So in addition to many of the law changes that Ryan just went over, one of the things that will impact companies are the ability to use losses on a go-forward basis, specifically in the C corporation space and also the flow-through space. So we'll start off with the C corporation space. The new laws for net operating losses are going to be limited to 80% of future taxable income, where in the past they could offset 100% of taxable income. There was an AMT portion of your NOLs that could have created tax in the past, which is now gone away. But for the loss companies, this 80% limitation may actually act as kind of a mechanism for paying AMT. And the nice thing is the new NOLs created after 2018 that are limited to the 80% will carry forward indefinitely. But you could get yourself in a situation between periods where you're accelerating too much tax depreciation or something, as Ryan alluded to in an earlier period, and then down the road when you've got the income, that income may not be offset 100%. And so you just need to be careful about planning between periods and how the losses and income in those two periods will shake out. So in the pass-through space, they also had some changes with respect to how losses will be carried forward. The slide is kind of wordy, but what I wanted to point out here is the second bullet point there for married filing jointly individuals and then for single individuals. When you kind of culminate all of your pass-through losses, you're going to be kind of limited to $500,000 in a particular year for married filing jointly, and then $250,000 in a particular year for a single or other taxpayers. So the thing to think about and be careful there is that you're not creating too much losses in a given period that you wouldn't be able to monetize those losses if you had other sources of income, and we're going to go through an example next. So in this situation, we've got an example where we have this is an individual taxpayer. Let's say they've got revenues and expenses from their pass-through entity of $1,000 and $1,350, creating losses of $350,000, and this is in thousands here. So if the owner were to pay themselves $250,000 versus $150,000, they'd be creating $600,000 of flow-through losses as opposed to $500,000. And as you can see, as that shakes through down at the 1040 level, if this particular taxpayer had other sources of income, say of $350,000, where your $500,000 would be limited, and you'd actually end up paying tax just because the owner paid themselves more. So the takeaway here is to know that this $500,000 loss limitation exists, and to also pay particular attention to the wages that closely held business owners are paying themselves, because it may behoove them to do it in form of a distribution instead. So a lot of questions in today's meetings and in business environment about whether or not we should be C Corp, S Corp, LLC, and so we're going to talk about choice of entity and some of the different law changes there that might impact that. So before we get to that, we're going to pass it to Emily for another polling question.
All right, and this is our second polling question. Which entity type is your business? C Corp, S Corp, LLC, LLP, or I don't know? And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And again, this is our second question of today. And I'll give everybody a few more moments to make their selection. And let's take a look at the results. Nick, back to you.
Okay, great. So it looks like we have a pretty good mix if you kind of add up all the pass-through entities versus the C Corp, looks like a good 60-40 split. So a lot of this stuff will be applicable to everyone on the call. So getting back to entity choice, as we all have heard in the news, the C Corporation tax rate had dropped to 21%. Having said that, there's still a second layer of tax that applies to the distribution of funds out of the C Corporation. So on the surface, while it may seem everyone should run and be a C Corporation, there's a lot of analysis and things that need to be looked at in order to determine if that's the right situation for you and your business. And to kind of give a break to the pass-through entities to match the 21% rate drop for C corporations, Section 199A is a new provision we're going to talk about over the next couple slides that could potentially give pass-through entities a 20% tax deduction associated with the income from that entity, which will effectively lower the highest marginal tax rate to just below 30% for pass-through entities. Section 199A did replace Section 199, which for a lot of people in the food and agribusiness and food processing space was something that they took advantage of in the past. Section 199 was essentially a potential 9% reduction in taxable income for companies that made their product in the U.S., and so that is actually going to go away. So, the question we get a lot is, should entities become C corporations? The answer is, generally, unless the facts align, it's still probably going to be less tax overall if you are a pass-through entity. And that is, again, because there's only one layer of tax associated with the earnings, assuming the earnings are distributed to the owners. There are some situations there where if the pass-through entity isn't eligible for the 20% new pass-through deduction, which we're going to get into in the next few slides, and the shareholders at the C corporation can either significantly defer the second layer of tax, or they think the second layer of tax will never occur, then a C corporation could be the right answer for you right now. But again, the facts really have to align for that to be the case. The other thing is for international and state operations, companies that have a lot of those, there's some complexities behind the filings, and so you want to consider that as well. There's some different law changes and different rules around international and state tax filings if you're a C Corp versus an S Corp, so something to consider there, as well as flexibility when it comes to estate tax planning. There's some more flexibility if you're a pass-through entity than if you're a C corporation. So the new 20% pass-through deduction for the approximate 60% of the people that are pass-through entities on this call, I'm sure you've heard a little bit about it, but essentially, as long as your business is not a service-based trader business, which is like law, accounting, financial services, and brokerage, then you're going to be in a position where as long as your wages in the organization are enough, that you're going to be able to reduce your income there that flows through the owners by approximately 20%. So again, that reduces the highest marginal tax rate down to just under 30%. For businesses that actually are precluded from this 20% deduction, there is one exception, is that if the amount of business income flowing through to the individual, even if they're in the service-based business, is less than $315,000, then and $157,000 for single and other filers, then they still will be afforded the 20% tax deduction on their individual tax return. So for those individuals that are between 315 and 415, you may still receive some benefit, but the benefit for those individuals will phase out until they get to 415,000 for a married filing jointly couple. So let's move on from those that are actually service-based and all other companies. If you have greater than $415,000 of pass-through income for all other businesses that flow through to the individual owners, what you need to do is look at the wages of the organization, the W-2 wages, and you take 50% of that. You could also, for entities that don't have a lot of wages, you can take 25% of the wages plus 2.5% of the unadjusted property, and this would be like real estate entities and other entities that don't have a lot of wages but have property within the entity. You take those two, you look at the higher of those two, and that's kind of your baseline for what you compare your 20% tax deduction at the income level for your entity. And in between those two is what you get to take a deduction for. So it's kind of a convoluted calculation, but make sure you're working with your service provider on running through those numbers and those calculations to make sure you're getting a maximum benefit. So really quickly, I'm just going to roll through this. This is an example where a C corporation or an LLC or an S corp has $1 million of business income. Let's say the pass-through entity does qualify for the $200,000 of tax deduction under the new Section 199A rules. As you can see, the way the math works out, if all of the earnings of the company are distributed to the owners, under the C corp setting, you're going to pay $398,000 of tax and only $235,000 at the pass-through. So, and a lot of that has to do with the fact that the individual rates, as Ryan referred to earlier, in and of themselves, the tiering is working more favorable for most of the American public that own businesses. And so as you can see there, definitely if you qualify for the pass-through deduction, even with the 21% rate in the C corp now, it's still much better to be a pass-through entity. This is kind of a more convoluted example. I just want to point out two things on this slide. The first, and this slide really goes through C versus a pass-through entity, and then whether the pass-through entity qualifies for the deduction or not, and then also looks at how much salary the business owner pays themselves. So the two things I wanted to point out, if you go to the far left, you can see that the net cash to distribute after all the taxes are paid, when a owner does not take a salary, those amounts are more, and that's because there's no payroll taxes and the 20% qualified business income is not reduced by the salary. And so I think the IRS is going to have a lot of emphasis on reasonable compensation of their owners because, as you can see, the tax paid is much less the lower the salary is for the business owner. The other thing I wanted to point out in this slide before we move on, as you can see, the C corporation, the net cash that it would be distributed to someone in this situation is always less than all three scenarios in the pass-through setting. So again, another example here about where in most situations, if the earnings is going to be distributed to their owners, that it's better to be a pass-through entity for tax purposes than it is a C corporation. So some other items to consider that I talked about before are there is different tax filings and rules about how to file tax returns and the complexity of those returns, whether you're a C or a pass-through entity, so look into that. The laws are different in the states. And the other thing, as Ryan alluded to before, if you're a C corporation, you would get to deduct all of your state taxes potentially, and then if you're a pass-through entity, those state taxes, depending on how the individual filings work, would be limited to just $10,000 on the individual level. A few other items to consider, C versus S, is that if you go to a C corporation, you can't go back to an S corporation for 5 years. That's just one of the rules that's always been there, so something to consider. The other thing is if you're going to go to an S corporation or an LLC and you are a C corporation right now, to watch out for the built-in gain tax or the Section 704C gain associated with converting your C corporation to a pass-through entity. Really what those are their gains associated with property being appreciated within the C corporation, or property being appreciated that is contributed into an LLC. So if that property is sold within a window of time and it's appreciated, then it reverts back to essentially C corporation status, where you have the 2 layers of tax. So if you are a pass-through entity, there's a couple of other things to look out for and watch for. The first is that what we call the tax deferral waive. What that is we do a lot of stuff throughout the years in terms of tax planning and everything else to reduce our taxable income as much as possible. But one of the things that isn't always apparent is when you do that year after year after year, what's your embedded deferred tax liability associated with deducting all those things for tax purposes right away. And the easiest thing to think about that is if you were to take all these tax deductions on, say, fixed assets, and then sell that fixed asset the next day or the next year, you would be taking a tax deduction for all those in year 1 when you took the deduction. But if you sold it in year 2, essentially your gain would be increased by whatever the deduction that you took in the past was. So just knowing your embedded deferred tax liability, if you, say, liquidated your balance sheet at book value or fair market value, just knowing your tax basis is a lot lower is just a key thing for business owners to do as they go throughout business and also maybe potentially plan for a sale. Another thing to really keep in mind are self-expenses. So as we've been talking a little bit about the 20% pass-through deduction on business income, you can see where if a closely held business and its business owner are having income and expenses that are offsetting one another on their pass-through entity, on their individual return, you want to rethink about whether or not you'd want to do that still, because in this example you can see here, if we've got a C corporation or an S corporation or an LLC with $1,000 of revenue, and the owner is taking wages of $175, maybe there's a note that the company's paying interest on to the owner, and maybe there's some sort of guarantee fee that the owner is getting. As you can see, that reduces the S corporation income down to $650,000. Well, we're only getting a 20% tax deduction on the $650,000, whereas opposed to below, you can see if you reduced the wages to $100,000 and got rid of the self-interest and the self-fee, you'd be getting a 20% tax deduction on $900,000 instead of the $650,000, which would give you a $180,000 tax deduction as opposed to $130,000. So as you can see, just by having income reported on the 1040, which is an expense on the business return, you're actually reducing the amount of tax deduction you otherwise could have gotten. So closely held businesses that are owned by 1 or 2 people or a few people really should think about how they're charging expenses between the entity and how that income is showing up on their 1040. Last thing I'm going to do before I kick it over to Ryan is briefly talk about IC discs, and we're going to have one more polling question before we get there.
All right. This is our third polling question. Do you currently have an IC disc set up for your business? And yes, no, or I don't know. And for those of you that would like a copy of today's slide deck, you can download that now from the folder that says Slide Deck and Handouts to the right of the slide view. We will also be sending the slides via email after the webcast. I'll give everyone a few more seconds to make a selection. And let's take a look at the results. Nick, back to you.
Okay. So for those that you don't know, I would imagine you would know if you actually had it. So it looks about a fifth of the companies on the call do have an IC disc, and about 4/5 don't. So there'll be some good discussion here. The IC disc, for those of you that don't have one, is essentially a separate entity that's set up. It usually has a similar ownership structure to the operating entity. And it's really for operating entities that have sales outside the United States. Now, the reason an IC disc is set up is because there's a tax benefit associated with them, and that tax benefit is generally calculated as a component of international sales or the overall taxable income of the operating company. And essentially what ends up happening is this separate entity and the operating company, the IC disc sets up a bank account, and there's funds exchanged between the IC disc and the operating company. The cash going out the door to the disc on the operating company is a tax deduction for the operating entity at ordinary business rates. And then the IC disc then distributes the cash back to the owners, and that distribution is at the capital gain rate. So there's a big tax rate arbitrage in whatever the IC disc commission payment or calculation is between the operating entity and the IC disc. So the other thing before we move on to the IC disc is just to consider the state tax implications as well. A lot of companies that actually have IC discs right now are worried that their IC discs are going to be less valuable from a federal perspective just because the tax rate arbitrage in the marginal rate are at the individual level are shrinking. But just keep in mind that a lot of the state tax implications, I know specifically in Oregon, have stayed the same even though the laws have changed at the federal level. So as I mentioned before, if your IC disc just has a basic commission calculation, which is again just transferring funds between the IC disc and the OpCo and creating a tax benefit at the individual level, for the tax rate arbitrage between the capital gain rate and the ordinary rate. A couple of other things to consider are IC disc optimization. And what that is instead of taking your entire company's operations and applying the most favorable method under the IC disc rules to the entire company's income and international sales for the whole year, what you do is you look at each transaction on a separate transaction-by-transaction basis, which is allowed under the rules. And what this does is that each transaction, it gives you the most favorable method. And when you kind of culminate that throughout the year, generally the disc optimization gives you a much better outcome than just a basic commission disc calculation where you're just looking at the company as a whole and applying just one method. The other thing to consider, if you have a good amount of international sales and you have an IC disc, is accounts receivable factoring, and that's essentially the operating entity selling its export-related receivables to the disc at a discount, and then the operating company takes a loss on the discount. Again, the whole point of an IC disc is to generate losses within the operating company and have income go to the disc, and then the disc can distribute that income out to its shareholders at a lower tax rate, because that is it's given the dividend or qualified capital gain tax rate treatment. The one thing about AR factoring is you probably will need to do a kind of a quasi-transfer pricing study, and your service provider, or certainly we can help with that because we've got a system in place to help companies do that. So thanks for your time today. I'm going to kick it back to Ryan to wrap up.
All right, thanks, Nick. We thought it'd be good to have a session in here on cooperatives, ag production and processing cooperatives. And it's not often that much of anything about agriculture makes the front page of the Wall Street Journal and other major news bulletins, if you will. But tax reform regarding cooperatives made the front page of the Wall Street Journal, and it's continued to be a topic of debate and conversation in industry as well as in Congress. And so, explaining it just a little bit, Nick explained the new qualified business income deduction under 199A that replaces the old Section 199. And it applied in two different ways for cooperatives. One, at the farmer level, if you're a farmer patron of the cooperative, you would receive a 20% deduction on your taxable income, but you would also receive a 20% deduction on all qualified payments from a cooperative to its patrons. Now, the critical thing to think about there is, as a farmer, and I'll have an example of this in a minute, is the way the law is written is for every dollar of gross receipts or sales to a co-op, you get a 20-cent deduction against that dollar of sales. At the co-op level, so not only would the farmer get a deduction, the cooperative would get a 20% deduction for the cooperative's gross income, in other words, gross margin, less any payments it makes to patrons. So just to provide a couple examples of how this worked. One, the first for the cooperative. So you can see here in this example, a cooperative that has $13.25 million of income. It makes a number of payments in cash and qualified allocations out to the patrons, and then it receives a QBI deduction of 20%. You can see off to the side the calculation of how that 20% deduction is made is first you look at the gross profit, in this case we assume $40 million, less than payments made to the members, and that's the $9.9 million figure. So you're roughly at $30 million of net QPI, or qualified business income, and then you take 20% of that, and that's the deduction at the co-op level. So here you can see a co-op would, under the new law, have the ability to zero out its taxable income. And then shifting gears to the farmer, you see there's a significant benefit to the farmer who sells to a co-op. So in this example, farmer A does not sell to a co-op. You can see they have sales of $2 million, $1.1 million of cost of goods sold for net gross profit of $900,000 and their various other expenses. However, farmer A, because they're not selling to a co-op, is limited to their 20% QBI deduction based on farm income. That limits their deduction significantly just to the $40,000. Farmer B, alternatively, they sell their crop to a cooperative. They get a 20% deduction against their gross receipts, limited to ordinary income. In this case, farmer B gets a $370,000 deduction, which was limited by $30,000 because they had $370,000 of ordinary income. So you can imagine the reaction to this between processors that are structured as cooperatives, which would be greatly to their benefit, and processors and grain handlers and such who are not cooperatives. And so there's been a lot of lobbying that has been ongoing since the first of the year. And I believe kind of some of the latest rounds of information that I've seen, it looks like both the Congress as well as an industry is coming to a workable fix. But then it's a question of how do you get the fix through Congress. In order to get a technical correction bill through Congress, it requires 60 votes from the Senate. So likely that may not be the easiest route, considering that the Republicans don't have a supermajority in the Senate. So in all likelihood, any fix would come through an appropriations bill or something of that nature where there'd be broader support. And really, there's a number of alternatives floating out there. We don't have enough time to go through those today, and certainly stay tuned as we'll be providing updates externally as we know more information. The one that seems to has gained the most traction is really bringing back something akin to the old 199 deduction, the 9% deduction specifically for cooperatives, but yet nothing's final, and please stay tuned on that front. moving quickly, because we're getting close to the end of the hour here, as many of you have been probably following the news, many of the high income tax states, have had a less than positive reaction to the state income tax deduction limitation of the $10,000 that we talked about earlier. And so a number of states have started the process of looking at the new Tax Act and looking at how they would either connect to it or disconnect, and when they would do that. Here on this slide, it's really more a reference point for the state that you're in. It lays out all of the states and whether they have a rolling connection, a fixed state connection, or whether they selectively adopt provisions of the Internal Revenue Code. And so by way of example, Oregon has a rolling connection, whereas California has a selective connection where they adopt specific provisions. Most states, at least our expectation is most states likely won't adopt the new 20% QBI deduction, but some may. So something to keep an eye out depending on your state of residency and where your business is located. I use the example, being from Oregon, of what Oregon has done. Oregon just got out of a short session here shortly, where they did a couple of things. One, they agreed to follow 100% bonus depreciation. But two, there's a special add back for all of the foreign deemed dividend provisions. So that'll be a revenue raiser. Three, Oregon did not follow the 20% QBI deduction as we anticipated, but they've set up an opportunity grant fund where it gives taxpayers the opportunity to buy a tax credit in lieu of a contribution to a specific fund. Many of the high-income tax states are looking at structures like this. The thing to keep in mind is that your state deduction is a federal deduction, so even though if a state puts a program like this into place, the risk of the deduction and the quality of that deduction is still points back to the actual taxpayer and their ability to take it. Lastly, as I mentioned, Oregon did not conform to the QBI deduction of 20%. At this point, I'm going to turn it back to Emily for the closeout and final polling.
All right, thank you. And this is our final polling question. What part of the Tax Cuts and Jobs Act interests you the most? The Craft Beverage Modernization and Tax Reform Act, changing my choice of entity, state impacts, or cooperative tax planning opportunity. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. I'll give everyone a few more seconds to make a selection. And let's take a look at the results. And we are running out of time for questions today, unfortunately. Ryan and Nick, thank you for a great presentation. We certainly covered a lot of material. If you have questions, feel free to submit them through our Q&A window right beneath the slide view, or you can reach out directly to Ryan or Nick. And if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today, and we hope you'll join us again next time.